right. Good afternoon, everybody. Sorry for not speaking Korean, but John Uea, I hope that said what is intended to say, but I tried to pick up some of my previous speakers. So let me start by thanking the organizers for the kind invitation. I had a marvelous time. Thank you, Professor Konmin Yang, for having me here at this very, very nice occasion. And also thank you to the ladies who provided the translation for me, or for the foreign speakers. That was marvelous. They even translated what I didn't understand on the slides. So very, very well done. Thank you for that. Okay, my task is to speak about the European insurance approach in the presence of climate change. I have to say it's a bit my personal view, and it's of course biased by what I think should be sort of the right approach. But I'll try to give you an overview on how things are developing currently, and what I think the future will hold in that direction. The sort of subtitle of the whole thing is called Products, Regulation and Skills. And what I think is what's going to happen, or what's currently happening is that in the presence of climate change, we think that the traditional approach we had in terms of risk management has to be replaced or supplemented by another dimension, such as climate risk is a systemic risk, and it brings another dimension in our risk management. So what do I mean by that? Well, if you think about risk management in a traditional way, risk management has to do with pricing. So we were thinking about generating a robust system, and a robust system that should observe shocks. So something comes into the system, a shock, and you as a robust system should basically bounce into the shock, sort of observe it, and sort of continue going on like that. And that meant that what you were going to do is you would sort of put some risk capital behind your operations. So this risk capital sort of is there for what happens to ensure that you continue to operate. And now the problem with climate risk is that we actually not able to price it appropriately. So what do we do if we sort of don't have the appropriate prices? We'll try to change the system in a way that the system is more resilient. So instead of having robustness, observing the shocks, we have a system where we sort of try to bend in a direction and then come back to the steady state approach in that. And in the insurance context, an example of that is the life insurance industry. The life insurance industry was under a lot of pressure when Solvency II came. And the regulator basically allowed the life insurance industry not to sort of provide the regulatory capital required, but say, okay, we'll sort of allow you for a limited amount of time not to have this capital, and then over time you would gradually come back. So in a like 14 years time span, they allowed them to come back. So they just made the system resilient. The shock was not be sort of observed, but it was like a resilient swing back. And products, regulation, and skills in that context means that we have to have products who have a resilient component. What do I mean with a resilient component in a product? That means that basically you not price as a reinsurance company or insurance company only the risk, but you also educate the people who sort of buy the insurance from you. So basically you incentivize within your products adaptation to climate change. Basically design products which not only sort of will be in place when the shock comes, but also are in such a way that the customer will move in the right direction. So the customer will increase resilience in terms of this product. So what does the regulator do? Basically, the BaFin, which is the German financial authority, has a statement where they basically say the same. Okay, we look after your sort of risk capital, the properties of you that you would observe shocks, but we also encourage you to move as an insurance company or the bank for that in the right direction to increase your resilience. So resilience comes in that direction as well. And finally, the skills. We advocate that actuaries, as you are, highly trained, you understand risk problems, that you also talk to your customers in a way that they increase resilience. So you educate your customers. Yeah, so I'll have a few slides on that. So basically, in a nutshell, that's all I wanted to say. Okay. So now I go through the slides and give you more information on that. But my basic argument is, in the presence of climate change, when we are not able to price the risk appropriately, we should adapt to the risks and not go away from a robust risk management approach to a more resilient risk management approach. And that should be reflected in the products of the insurance industry. That will be reflected in the supervisory approach, and that should be in the skills of whoever sort of does insurance in a company. Okay, so try to manage that. So this is, of course, one of the pictures example you've seen. This is the R value in Germany 2021. I've never thought that during my lifetime we would have a flood in Germany that would kill more than 90 people. That happened in this R value because of torrential rain that came down very, very quickly, quite a lot, and there's a small valley, and basically the flood swept through it and killed in the matter of a few hours more than 90 people. And still the damage is there, and 2 years after or 3 years after, you can still see the after effects of that. I have to use my glasses now to read my own slides. So this flood killed more than 180 people and had damages in order of 33 billion euros, but only 8.4 euros were covered by insurance. So this is first a sort of type of topic, but Kwang Ming already referred to that. There's an insurance protection gap. And this insurance protection gap goes across the whole European Union. Only about a quarter of possible losses are covered, and in some countries it's like 5%. But one of the effects of insurance is that you basically ease the sort of development of the GDP of the economy as a whole. So we know that physical damage to assets will reduce collateral values and will also lead to repricing of loans and securities for financial institutions or financial institutions exposed to this area, which means that a disaster strikes and you're not really insured. You lose the value of the buildings you have there. That means the collateral you pose against banks is being reduced, and it will be harder for you to obtain loans and credit at favorable conditions. So that will be a problem, and that will affect the whole economy. Yeah. You can also have supply chain disruptions, and again, that will have effect on the real economy. So it's very important to make sure that there is no protection gap. It's very important to think about ways to cover this protection gap. And this is sort of the way we want to think about products. So here's just a slide and which says the amount of collateral for banks which is not covered by insurance, and it's substantial. So banks are basically exposed to a risk of non-covered sort of non-covered physical risk in some areas. And if disaster strikes there, the disaster will strike on the balance sheet of banks as well. So there will be a knock-on effect through the whole system. So we need to make sure as a society that we cover this protection gap. Okay. So we have a pricing challenge here, and the greater frequency and severity of natural disasters sort of leads to all kinds of risk, and you have seen that already. Let me focus on the second bullet point: changes in climate and weather, exacerbated by non-linearities and feedback loops, trigger points, can accelerate the temperature rise and basically have devastating effect. So two things to say here. I mean, we are risk managers, okay? We don't like mediums, we don't like averages, we are in the extremes. Yeah, we live in the extremes. This is where what we like to model, this is where our mathematical models comes in. So low probability, high losses, that's something we want to look at. Now look at climate change. All the communication about climate change is averages. Okay, the global average temperature will increase by 1.5 degrees. Super, but in some areas it will increase by 4 degrees or 4.5 degrees, even if we keep this 1.5 degree target. So you look at Greenland, yeah? Our good old friend Donald will buy Greenland. Why? Because of climate change. You can sort of find natural resources there, but also the ice is melting. Okay, the ice melts in Greenland. What does it mean? Well, ice is white and reflects. If it's gone, it's dark sea. Dark sea doesn't reflect. Okay, so you have a feedback effect, which is problematic. The other point is look at the fires in Los Angeles. What you read is, yeah, it was exceptionally dry, but that is not the main reason. 2 years and a year ago, it was exceptionally wet. Yeah, there was a lot of rain coming down. What did this rain do? Well, the rain increased the sort of growth of trees and plants. So you had many more trees and plants there growing as before. And then the dry spell comes, and you have much more stuff to burn there. Yeah? Why? Because we have a temperature rise of 1 degree, 2 degrees. A degree temperature rise means the atmosphere absorbs up to 7% more moisture. So if there's more moisture in the atmosphere, it will come down eventually. Came down in Los Angeles, the plants were growing, there's a dry spell, the plants are drying, and the fire comes, and you have a much more intensive fire than ever before, right? So there are feedback effects and loops. Okay, and also the world is changing in that context. Spatial and serial correlation of events across regions and countries are affected, and they reduce the potential of sort of diversify your underwriting portfolio. So all your correlation modeling, your dependence modeling is changing. And the data you have from the history doesn't help you anymore so much. Yeah, you have to have a forward-looking approach. Okay, one thing I realized during this workshop is that everybody was on time. So I'll have 15 more minutes for 80% of my slides. So I'll have to speed up a little bit. I will be on time as well. Okay, so what else to say? So let me again go to the second point. What we have to do is we have to design insurance policies that basically trigger adaptation measures, and if you sort of behave in the appropriate way, your insurance premium might change. Let's look at a property. If you build a property, say in the right way, fireproof, this is one picture of a wholly burned Los Angeles area, and there's one white building standing there. And this was the only one building that was built by concrete. Everything else was wood. Everything else burned, but this building, fireproofed concrete, that survived. Yeah? And you have to sort of incentivize people to adapt for climate change. And you could put that in a different direction. You can also incentivize people to put mitigation measures in place. So if you have a very good insulated house, yeah, maybe you pay less premium because that is sort of a forward-looking approach. So something like that should be in the insurance premiums, what I meant, increased resilience. Yeah? Increased resilience as an insurance company with your action. Okay, so basically let me run a bit through that. We had cat bonds already, so new insurance type of contracts which would allow for longer term insurance contracts. Typically reinsurance is on a yearly basis, so you don't have much incentive to put sort of all the risks in place immediately because you can renegotiate in the next year. Something like that, a cat bond with a longer period will sort of incentivize people to think in longer terms. Also, if you have a cat bond, you can also use the proceeds to sort of finance green infrastructure or something like that. Yeah, you could. The World Bank has such a cat bond, so you can sort of move these things around. So that is also one way. So you have innovative insurance products such as cat bonds. Let me go a bit further. Cat bonds are typically priced as parametric products. That means parametric products is basically you decide on an index, and then you have a trigger value, and as soon as some event happens that crosses this trigger value, you generate a payout for your insured, which has the advantage that the money is flowing immediately, yeah, and you don't have to have sort of these claims coming in and you pay back because of claims. If this sort of trigger is hit, the payout is being done. So let's say if there happens an earthquake in some order in a certain area measured there, then you immediately pay out to the homeowners, which would mean that you have like a short delay in basically the event happening and the payout happening. Yeah, and these products are on the rise in the European market. Of course, you have to be very careful, set the parameter right, get the models in the right way, but that is something that is happening currently. Right. We had also the public-private partnerships that were mentioned. They are in place in Europe increasingly, and if you go through the slides and I mean, see what I've written about there. You see how they're designed and what problematic aspects and less problematic aspects they have. So I refer to the slides in order to keep the time. Let me talk a bit about regulation. The BaFin, the Bundesanstalt für Finanzdienstleistungen, is the Federal Financial Supervision Authority in Germany, and I was amazed to hear yesterday that your supervisor also takes care of companies, of financing companies. That is not the case in Europe or in Germany. The objective of the supervisor is to ensure the proper functioning, stability, and integrity of Germany's financial system or the European financial system. So the idea is that customers, insurance policyholders, and investors are able to trust the financial system. And the BaFin basically checks the regulatory capital companies have, so the robustness thing, but they increasingly look at the resilience. So they increasingly try to sort of measure how resilient is a company in terms of climate change or a financial institution. And the way they can do that is the following, which we suggest. Namely, if you want to go away from the robustness issue, you have to be aware that the standard risk principles are no longer functioning. If you look at the standard risk metrics, you have like value at risk. Value at risk in principle says, if you think about it, that capital helps against everything. So you can reduce your risk measure of a portfolio by just adding capital to whatever risk you have in the portfolio, and that reduces the risk. So that simply means money helps you out of that. So you can calculate a risk which you can aside against capital. The sort of climate change literature says, Lord Stern, who did this report for the British government, says climate change is still the biggest market failure in history. Emission costs are still mostly loaded on the planet rather than borne by the polluter. And why is that? Because we cannot price the effects of climate change appropriately. Let me tell you another current trend in the European system. Climate change is one thing, emissions is one thing. The other topic we have in the last couple of years, biodiversity. You destroy biodiversity by your economic actions, and also biodiversity is good for the public. And this destroying of biodiversity is not really priced by the market. So increasingly the regulator takes that into account so that economic actions also should make sure that biodiversity is preserved. Yeah, don't cross global climate and biodiversity boundaries. So that is a trend that we see. But returning to climate change, we know that the problem in climate change, the temperature increase, comes from emissions release. So the more CO2 you have in the atmosphere, the more severe will be the climate change. So what we know is that in order to keep a certain temperature limit, we have to stay within a certain climate budget. So for instance, in order to stay below 1.5 degrees, we can only release 65 gigatons of CO2, well, from now on. Yeah? We currently released 11 gigabyte per year. That means we have roughly, if we have an upward trend going, we have roughly 5 years more, and then the carbon budget is gone for 1.5 degrees. So we can think of technologies to remove carbon from the atmosphere. It's clear that we will send carbon in the atmosphere long before we sort of are way overshooting our carbon budget. But what we propose in order to have this regulatory effect, which aims at resilience and not only at robustness, is to measure the carbon emissions and the trend of carbon emissions of companies. And with my research group, we have implemented a way to do that. So basically, based on historical emissions and and sustainability report of companies and their public sort of voices, we can implement a model that gives us the trend of their carbon emissions. So this is basically the way that looks at the historical estimations. So we put emissions, we put a model on that, and we predict their emissions in the future. And with that, we could go to a company and say, okay, the company has a certain carbon budget in order to be aligned with a degree aim. And we can see whether or not this company will sort of cross this carbon budget or not, stay within the carbon budget or not. So you have a way of assessing a company and saying, okay, you will probably use too much carbon in order to keep a 2 degrees aim, which you may claim. And the regulator could use that by just saying, okay, this is my regulatory approach. You have a financial budget together with a carbon budget. And in a company, you compete for finance for projects, but also for emissions for projects. And many, or not many, but some sophisticated European companies are doing that. Banks are doing that. So Deutsche Bank is doing that, BNP Paribas is doing that. So they actually have a carbon budget for their actions and the projects they finance, in addition to the financial budget they have. After all, banks were claiming to be net zero in their financing in 5 or whatever years. So they should only finance projects which are within this carbon budget. So we can actually also use it for investment portfolios. So you can use this approach and see and give a carbon budget to your investment portfolio and decide which probability you want to keep this carbon budget. So resilience in the regulatory approach could be measured by staying within a carbon budget and by actions a company takes to stay within the carbon budget. Right. So let me come to actuaries. In this Embrechts and Wüthrich paper, actuaries of 1 to kind 5 are defined. And let me sort of just refer to kind 5. As data-driven and model-guided individuals, critical and socially responsible decision maker in ever-changing world governed by uncertainty. Yeah, it's still data-driven. What we propose is actually an actuary of the 6th kind, and the actuary of the 6th kind is acting socially responsible, but also in selling his or her products to the customers, educates the customer. And because we as actuary understand tail risk and understand sort of very high risks, we are able to communicate that to our customers. And if you're a sophisticated insurance company, your employees understand that. And all the talks I saw this morning were a very strong indication that you all are able to manage and sort of talk about risks very precisely and in an educated way. You have, I think, understanding what probability means and what risk means is one of the hardest things you have around, that is around. To educate people to really understand what probabilities are very important. And actuaries are in a position to do that and act socially responsible in educating people around and selling products within that framework. Okay, so let me come to a conclusion. So can capital requirement change behavior? And our answer is probably not. Financial exposures are considered at least as tolerable. Many financial risks are not tolerable. All risk may be replicated by assets as an underlying assumption if you do a robust way. Climate risk cannot be replicated. They cannot be hedged. You don't know how to price them. You don't have products to hedge them. How will you do that? Risks are adequately priced as arbitrage is possible. Climate risks are not adequately priced. We can do calculations on the social cost of carbon, and we can compare that to carbon prices and emission trading schemes, and the trading schemes are far off. Yeah? Most systemic risks are not insurable. They are not hedgeable. See the example I have with the R value. See the LA sort of fires. We're not able to insure them. Tipping points of social financial systems are weakly regulated. So if our system is changing, regulation may not be in place. The Credit Suisse case in Europe was a case where a major European bank was on the brink of going bankrupt. And there were regulatory sort of recommendations in place. For that case, that a system-relevant bank would go down, the regulator had developed a plan. Did the regulator follow the plan? No. They just made the other Swiss big bank buy a Credit Suisse and sort of act against the regulatory plan. So these things are not very, very well regulated, and they regulate it on an ad hoc basis. Of course, with climate risk, you have this climate change trilemma. You have to you have to try to reach the climate goals, but you also have to do it in a politically feasible way. You see that in Europe, where right-wing parties are on the rise who deny climate change. We had this big backlash in Germany when we wanted to do something on making sort of heating less CO2 intensive. There was quite a big discussion on that. So that is where we should try to find our way. And I collected a lot of business cards, and I don't have a business card to give back. But here's my email address and my contact address. So you'll have it in your documentation. Do contact me if you have any questions. Thank you for your attendance, and it was a pleasure to be here.